There are things when it comes to investing that sometimes just don't make any sense. Like, it shouldn't matter which month you're investing in, let's say in the stock market, there shouldn't be any difference. But statistically, actually, some months are better than others, and some months are actually pretty bad. Talking to you, September. So we're going to learn about today is all about what is the different returns by month, so you can see which months are better than others, why that might be occurring, and also should we change our investing behavior because of this, what's called the calendar effect, where you might have some months being better than others. All that coming up. Welcome to the channel, where we help you to learn fast so you can become a confident and successful investor. If that type of information sounds good to you, do hit that subscribe button. Okay, let's talk about this calendar effect and how it might affect us as an investor. And is that with an E effect or was that with an A with effect? That's a great question in itself. And also talking about words, you ever have words when you're growing up that you just had a hard time saying? When I was a kid, I just could not say the word aluminum. I have to think about it even right now to say it. And so another word I struggle with is anomaly. And so one thing about this is an anomaly that we're talking about when it comes to investing in the stock market. And by anomaly, if we look at the definition, is basically something that deviates from what is standard, normal, or expected. All right, so when we think about investing, it shouldn't be, it shouldn't deviate or be different from each month, or it shouldn't matter just because of the month. It should matter because of maybe when earnings come out, or certainly individual companies have better results and better months than others or something like that. But collectively, it shouldn't matter by month. But there is, if we look back in history, and there's been some research done on this, it does vary by month. So let's take a look at that, and then we're going to talk about why that is. In particular, we're going to focus on a few of the key months that are really well known. So if we look at one statistical thing here from stockanalysis.com, there's other ones out there, but they did an analysis where they looked at the S&P 500 stock market, the 500 largest USA stocks, from 1980 to 2019. So you got about 40 years, or about 39 years. And you can see on the under each month the returns that you're getting by month. So in January, you could expect if you're investing in the S&P 500 index fund, you're going to get a little less than 1%. You're going to get a 0.82, and then February 0.29, and so on. And that you can see during this time period that August was a down month, and September by far was the worst month, 0.70 or 0.7% on the loss side. And then you can see the other months there too. For an average during this time period of the S&P 500, 0.67 of what they looked at. By the way, this tends to apply across all markets. So no matter what part of the world you're investing in, this type of, correlates all together. Though a little less correlation with China and India, for example, but it still directionally correlates. So if we look at that and we say, well, okay, as an investor, I should definitely not buy right in the early September because look, I'm going to lose 0.7 right off the bat, or maybe I shouldn't buy in, before August. In fact, there's an old saying to sell in May, right? And if we look back at that old chart there, though it's not exactly right, but as terms of, but May, you can get all your at the end of May, you'll get your 0.97 and then you can go away. It was like sell in May and go away is actually the phrase, because you'll have lower returns. June is only 0.02, but July tends to be good, but then you have these losing months. And then you come back like in November, as far as the sell in May and then return later type of idea behind that. So this is the actual statistical numbers, but what might be happening here? Why is September not so good? And why does actually October have a big reputation for being a bad month when it turns out it's a positive month? And there's a reason for that. So let's talk about that a little bit. And we'll start with the September effect, all right, with an E, right? I think that's right. The September effect. And as you saw, the September is the worst month by far statistically for investing in the stock market. At the end, we're going to talk about if that matters at all, especially for long-time investors, so stick around to the end. So what might be happening here? Why is September so bad, right? So there are some theories out there that might be why this is correct. So let's review some of those theories. And again, this is not limited to just the U.S. stocks. This is a worldwide phenomenon that this happens with, some more so than others. So some analysts consider the negative effect on markets to be attributed to seasonal behavior, or what's called seasonal behavior bias, actually a thing, where investors change their portfolios at the end of summer to cash in. The idea is that they're on vacation. Big mutual fund managers might be on vacation or taking vacation during the summer, and so they're not actively trading their stocks as much, for example. So it's kind of lightly traded, and that's trading volume is lighter during the summer. You can statistically see that too. So then if they've had a run up during the summer, or wherever they're at, or if they've actually had losses during the summer, that's when they come back and they're like, okay, I'm going to now focus on my stock investing. I'm going to go back to maybe being a part-time day trader, and now we have more people trading, more volume, and you have more selling pressure because people are changing their portfolios after taking the summer off. So theoretically, you should have more buying and selling, and thus even more buying should raise stuff up, but it tends to be more downward pressure on selling. So there's more pressure on the selling side of it, where people are trying to get rid of some things. Maybe just totally just cash in. Maybe you have retirees or other folks that already had saved up money and cashed in earlier, and now they use that money to spend during the holiday, or they put it on their holiday on credit card. Like, oh, we need some money, maybe we should sell some stock. Not a great idea, by the way, but that's how people do it, especially if you're in retirement and you're using it to fund your retirement, versus like, oh gosh, I overspent on that big trip, I better sell some stock out of my retirement fund. Not good. Additionally, what you might see is downward selling pressure in September from mutual funds. More so, you're talking about actively traded mutual funds. Index funds, not a big deal because they don't actively trade like that. It doesn't matter the month to an index fund. But for an actively managed mutual fund, where you have a fund manager who's in charge of the mutual fund, and they get evaluated on that mutual fund's performance. They get bonused on that. They get to keep their job, depending on how well they do as well with their mutual fund. So what might happen is a lot of mutual funds have their fiscal year actually ends in September, right? So you have calendar years for businesses, January, December, but a fiscal year in a company could start anytime. And many mutual funds, not all, but many of them, their fiscal year ends in September. So if I'm an actively trading mutual fund manager, I'm in charge of this portfolio, and I might be looking at and say, I need to sell some of my winners to kind of make my actual return, because return is based on what I'm buying and selling. In this case, that I might want to sell before the end of the year, end of my fiscal year, because all I care about is my bonus and how I look and keep my job. So maybe I want to sell some of those stocks and that ends up putting some downward pressure on September. Another theory about why September might have a lot of pressure on it. So as I record this video, for example, we were 7 straight months of the S&P 500 showing positive returns. I mean, it was really a pretty high trajectory. So if you think about that, we've had 7 straight months of positive returns in anything without kind of a blip or a pullback. That puts even more challenge that potentially you might have a pullback. So if I've had 7 months leading up to September, there's an opportunity that there might be more of a pullback and thus a loss in September again, because the previous 7 months were all positive at the time of filming this video. So those are some of the theories around September, and statistically it bears that out, that September is the worst month as far as if you were buying at the beginning of the month, at the end of the month you would be down about 0.7%. Again, not the end of the world. We're not talking like, oh, September you're always down 10% or something like that, but it's something to be aware of. And at the end, we're going to again talk about like how aware, it's good to be aware, but should you take action on that? Now let's talk about a really scary month. We're going to talk about 2 more months, and one's a little more scary, and one's very positive month that we want to really understand the positive month when we should be, maybe buying. In terms of buying, maybe you want to buy at the end of September, but there's a problem, and that's October. October has the big reputation for being the scariest month, for being, the month with the biggest losses, whatever. That's its reputation, though it's not necessarily true in that effect. So if we think about what's called the October effect, actually also well known as the Halloween effect. I mean, that's scary, right? Kind of goes in with being scary. So it's the Halloween effect. And people will think that October tends to be the worst month. I always thought that because in my early investing career, maybe like after first 2-3 years, I was like, gosh, I'm always getting wiped out in October, or it always seems to go down in October. Well, I only had my own mind. I only had 2 years of data. That's not statistically valid. When I'm looking at only 1 month, that means I have 2 data points, 2 years of October. But I had 2 bad years in October. And, as far as when the overall market was down, I'm like, gosh, October, maybe. And if I came into money maybe at the end of September, maybe I got a bonus, a quarterly bonus, which has happened, right? I got a quarterly bonus at the end of September because the end of a quarter for just my regular job. This is years ago. And then I say, well, okay, I'm going to invest it. But I'm like, October, so bad. Maybe I'm going to wait and I'll invest in November. And a lot of people do that because they're scared off by October. Now, why would that be? If you think about October, some of the worst days in the history of the stock market occurred in October. Look at some of these days. Black Tuesday in 1929, Black Thursday in 1929, Black Monday in 1929, Black Monday again in 1987. A whole lot of downward days, right? As far as these days. Now, if we look at those particular days, you can see 1929. What's 1929? The Great Depression, the stock market crash, right? So it's all hovering around really just kind of a one time period there. 1987 was an anomaly. We're out of almost nowhere. The Dow, the 30 U.S. stocks was one measure, plummeted 22%, 22.6% in a single day. Imagine that. Think about your own portfolio right now, that what you've got in stocks just dropped in one day. Overall, your overall portfolio dropped in one day 22%, almost a quarter down. Think about how you would react to that. Would you be selling like crazy, or would you hang in there and maybe even buy more when it drops like that? Always a good buying opportunity when things go really haywire with the idea that they're going to come back. But you can see where that reputation for October and that scary Halloween effect, like, gosh, I don't want to buy with something that's going to go down 22% possibly. I mean, it happened before. Back in 1987, I remember. I don't remember. I was a little kid. But, and maybe you weren't alive. And I certainly wasn't alive in 1929. I know I got some gray hair going on here, but I'm not 1929. So that's where it gets that reputation from these big market moves. But as we saw on the first type of chart that we looked at, October is actually a positive month. So it's like, it's not a bad month. It's not September. So why does it have that reputation? Well, 2 big reasons. One is these big drop days that we talked about. So it has that certainly in the reputation. The other reason is that October actually, based on some research, LPL Financial did some research around looking again at the S&P 500 and found that October, of all the months in the calendar year, was the most volatile month. And by volatility, we mean, range of prices. Prices go up, prices go down, wide swings. A less volatile month would have narrow swings, right? So it wouldn't be as far up or far down. But October has the widest swings. In fact, there are more 1% or larger swings in October in the S&P 500, more so than any other month in the, going back all the way back to 1950 was the LPL research. So what that means as far as a larger swing in a day. So where you're investing in one day, maybe it's October 3rd, it goes up, and then October 4th, it goes down 3, and then up 1. They had more 1% or larger swings. And 1% is kind of like this volatility measure a lot of people look at where it's like, that's a big move. Usually the stock market has these little tiny moves. And then in the overall time, these little tiny moves start moving up, 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 up over time to eventually, especially if you're a long-time investor, a buy and hold investor, you're going to have hopefully a big pot of money at the end. That's the goal. That's what we're looking for here. But October, bigger swings. So that's where it gets that reputation, not only for what happened in the past with these big drops, but also it's just a crazy volatile month. One theory around that's postularized out there. That's another word I'm struggling with. One theory out there is that October precedes November. Wow, that's something. Write that down. October precedes November. This is what they actually say in some of the research of some of the theorists. But what happens in November is in early November, the United States has elections, right? We have our national elections. Every 2 years, we have elections for our congressmen and many of the senators in our legislature. And then every 4 years, of course, we have elections for the president. And these are things that can impact markets depending on which way, an election might be going. So, a lot of times the markets are trying to figure out, like, oh, who's going to win that president election? Oh, it's going to be this person. Oh, the markets don't like that. Oh, wait, it's going to maybe this person. Oh, we like that. So that leads to volatility. So that's one of the theories behind it. The thing to take away from statistically is October, not as scary as it sounds. It's a positive month, but October always has that reputation. I certainly found that when I was younger, little, baby investor, baby Mr. B. All right, now let's talk some positivity. We need some positivity. September, October, not so bad. January, that's the month. In fact, you might have heard of the January effect, a very common thing known as the January effect. And there's some really great theories around the January effect. And coming up, don't worry, we're going to talk about, should we even follow this stuff, right? And invest based on this. So in January, the S&P 500, look at some of the research again and statistics out there, the S&P 500 has risen 62% of the time, looking back in time in January. So that's really good. That's more than half, right? Now, how much? It varies, but you could see on our original where we looked at the whole of the months, that January was a good month, is always a good month. The funny thing is a lot of people think, well, December is not good, especially early December and maybe late December, and there's some, we'll talk about that, but it ends up December is really good too. And then January is the famous one with the January effect. So 62% of the time, the broader stock market, like the S&P 500, rises in January. So why might this be? Why might be people doing that? Or why might this be occurring? Again, these are all kind of theories and guesses, by the way, but these are the popular theories that are out there. They're not me making this up. This is, you start reading stuff, this is what they always talk about, right? So one, and some of these theories, by the way, actually make sense as far as, oh, that makes logical sense. And this is one of them. And that is where investors sell winners, stocks that have gone up, to intentionally incur taxes, to intentionally incur what might be called a capital gains, or it's called a capital gains tax, by year end, and use those funds to speculate on weaker performers. So what's happening, let's walk through that a little bit. What's happening is, let's say I've been investing in the stock market for the year, and I've got some ones that have done really well. And let's say my income from my job or other things is not as high, or I've got room in the tax bracket, where I'm like, I decide I don't want to take my taxes from selling for profits next year. I want to incur some taxes this year. This all gets about how you want to manage your taxes. So a lot of people are like, okay, I'm going to sell my winners to incur the taxes intentionally in December because I want it in this past calendar year. And then I'll put that money in cash. And then when January comes in, then I'm going to get back in the market and I'm going to buy, some of those stocks that are, they're out there, especially some of those weaker performers. Because you think about it, if everybody's kind of doing that in December and they're selling their winners, that puts downward pressure on those folks. There's more sellers than buyers, right? Supply and demand, more sellers than buyers. So they're selling, these prices of these stocks go down at least a little bit. And some of these are really good stocks, but they go down with that pressure is the idea behind it. And thus they go down in price in December, and then in January when money's now flowing back into the market into the new year, they're going to buy those and drive those back up. And thus overall in the broader market, like an S&P 500, the broader market rises, the idea. So people are putting cash back into the market. I think that another good reason around this is psychology. I love behavioral finance because if you look at a lot of finance stuff, it's all tries to portray itself as black and white, right? There's, investors behave this way because it's in their best interest. So this goes all the way back to Adam Smith and invisible hand stuff. Look it up if you're interested in reading long, boring texts on finance. It's not boring, but it's kind of boring. But it's the idea that people, of course, are going to do things in their best interest, but they miss the behavioral part, the behavioral psychology. You ever hold on to a stock longer than maybe you think you should have because you didn't want to sell it, or maybe you sold too soon, or maybe the market's crashing, you get a little panicky and sell a little bit? Everybody does it, and don't worry about that. Don't beat yourself up with that, because finance isn't the invisible hand. Finance is behaviors. We are human beings. So let's think about the psychology of why January might be a good month. Again, more money coming in, more people buying, lifting up prices. What happens in January? What happens at the beginning of January? We make New Year's resolutions, right? Have you ever made a New Year's resolution? Maybe to lose some weight or exercise more or get a new job, whatever it may be. Do you have ever made a New Year's resolution? Many people have, I'm sure you have, or at least thought about it. And so a lot of people start investing or start being more interested in investing because they're like, I got to get my financial house in order, or I need to invest more because I need to save for retirement. And so investing actually has a lot more interest in it during this January period, like other things that have resolutions, like, of course, the weight loss industry and diet and exercise and all that. That January's massive for them. That's their big time of the year. Actually, for investing, that's a big time there too. As you know, I sell courses, for example. One of the best months for me when I sell my online courses is January. Why? Because a lot of people want to learn about investing, or it's a resolution for them. So that's the same with the market. People are putting cash in, they're going to start investing, or they're going to invest more, and that again helps rise the overall market because more money's coming in and we're buying. That's what people are doing, the buying. Another interesting theory, and this actually happens, I think this happens as a matter of degree that this happens, but you have active mutual funds, right? So you have these big monster mutual funds that are actively traded. Now that's completely different than an index fund, where an index fund is tracking a particular index. So when I'm talking about the S&P 500, 500 largest US stocks, a fund that tracks that index doesn't buy and sell, constantly trying to pick winners. They basically buy that index and then, playing for the average there, but they're not actively buying and selling. Versus, let's say, an actively managed fund where in my fund, I invest in large cap tech stocks, right? So, and I'm always buying and selling tech stocks based on who I think is going to be a winner and selling my losers. So I'm constantly doing that as a fund manager, or not me personally, but a person who is an active fund manager. So what can happen at the end of December that puts pressure on December and why people might be coming back in January? So what happens, or can happen, is what's called window dressing. Window dressing is the term for it. And basically, if I'm an actively managed fund manager, maybe I'm not doing so well, right? I'm behind my peers. And maybe my peers picked out some certain stocks because they can pick and choose once they're not following an index that really turned out to be great, right? It was Tesla in 2020, right? The best performing stock in 2020, 99.9% was Tesla. Or Zoom in 2020. What's happened in 2020? COVID, right? So Zoom went zooming up, as far as virtual communication. But let's say I didn't buy those stocks, and so now it doesn't look, and I'm underperforming. So what can happen with an actively managed fund is the fund manager will look at that and say, I got to look a little better on this. People are going to look at my holdings, they're going to look at my performance and say, oh, that dummy, he should have bought Tesla or Zoom. What's wrong with him? I'm not going to invest in that fund. So what they'll do is they'll sell other stocks. They'll buy then Zoom and Tesla. By the way, buying them probably towards more of a peak, not good, buying them with the idea of window dressing or making their portfolio look better. So if somebody looks at their top 10 holdings, they can see like, oh, well, his fund didn't do well, but look, he's investing in Tesla and Zoom, at this particular period of time when they did well. Maybe it's not so bad. So it's kind of a fake out, really. And that's actually a big problem with actively managed funds. That's one reason index funds are growing so much, because you don't have those, shenanigans. You don't have that kind of, fraudulent behavior. Basically, if your fund manager is investing particularly in just a way to make it look good for themselves, that's not good. So but that can happen. So they're selling those in December. That creates bargains in January, right? So they're buying these, let's say Tesla and Zoom, but let's say they're selling another stock and putting a lot of down pressure on that stock. So that's being really sold off a lot by a lot of mutual funds, big mutual funds. So then when January comes in, these same mutual funds are like, that's really good stock. I'm going to buy into that and get rid of my Tesla and Zoom that I bought at a peak. And I'm now going to buy this other stock. And then maybe if it works out, great. If not, I'll just do window dressing again at the end of next year. But when it happens, those bargains can become, really great opportunities. So if you have a lot of year-end sell-offs, whether it's from big-end mutual funds or from just regular retail or regular investors out there, you can have these, these big sell-offs of stocks that create buying opportunities, some bargains. In fact, you would call that, you're looking for bargains. Is what's called value investing or value investors. Warren Buffett is a famous value investor where they're looking at good companies whose stocks are not based on fundamentals or anything like that, or the company strategy just has some downward pressure, and then or something happened, maybe for a small hiccup, they missed an earnings announcement. But either way, their stock is now down, the price, and it's a real bargain to buy. That's value investing. I have an entire course just on value investing. I have a complete stock market course, dividend courses. I have a lot of courses on on stock market investing, check out all the information below as far as the courses and some free courses and some discounts. But value investing, I have a whole course on that. So if you like the idea of any time of the year buying, stocks at a discount and how to find them, check out the value investing course. But that's the idea is December, stocks have been driven down, and thus, people are now buying these bargains or values in January, again, lifting up the overall market. So the big idea for January, though statistically it's not necessarily larger than any other months, it's larger than many, but not as large as some others, is the big month where a lot of people say, oh, I'm going to buy in early January, I'm going to buy those bargains. So that's the January effect. And before we talk about whether you should consider investing based on calendar stuff anyways, one thing about January effect is it's not as impactful in more recent times than others, and there's some ideas around that. One, people are aware of this. This is nothing super brand new, this January effect. So since they're aware, they adjust their trading accordingly, right? So they adjust their trading accordingly, and so if everybody's kind of adjusting at the same time, then you're not going to have these anomalies because everybody's doing the same thing, right? So that means there's no anomaly if everybody's kind of starting to start thinking the same way. Also, more people are using, and there's more opportunities to use, tax-sheltered retirement plans. In the United States, we call that like a 401k plan or a Roth IRA plan. Other countries may have their own versions of different tax-sheltered plans. So if you're investing primarily through a tax-sheltered plan, it doesn't matter about trying to incur a loss at the end of the year or selling winners or doing anything based around taxes. Because you're in this retirement plan that's tax sheltered until someday when you need the money, for example. So that lessens the impact too. Also, we've seen a lot, of course, the rise of index funds over the last several decades. In index funds, there's more of them out there, more money's out in index funds than ever before, and that's continuing to grow year over year over year as actively managed funds go down, index funds rise. It's going down as far as people investing in them, and then also because of trading fees and things, actively managed funds can be more expensive. So as index funds rise, then you have money that's kind of in the index and not being actively managed. So you don't have to worry about like window dressing by your actively managed fund manager or anything. Because index funds, they don't care about taxes. Index funds don't care about year-end reports. It's just we follow the index, right? And then also another thing is the power to the people, power to you and me, right? More retail and smaller investors are investing themselves in the market, right? So instead where you had some big companies really, impacting the market, this is many, many years ago, you now have lots of little by small holdings, small, people, individual people, right? So it's me as an individual person, you as an individual person. Since there's so many of us, we have a greater impact on the market than even a big mutual fund company like Vanguard or Fidelity. So thinking of that, that's where that January effect becomes less impactful because you don't have a few companies doing the same thing, moving an entire market or having a lot of pressure on the market. You have a lot of individual investors doing their own thing, and that's actually very healthy and good for the market. Okay, so should we change our investing behavior based on what we know about some of these calendar effects? And before I give you my opinion on that, I'd love to see yours. Put it in the comments below, or after I talk a little bit too here as well. Just put in your own comments, your own thoughts, your own theories around this. It'd be great. Would love to see them. So put it in the comments below. So with that, I would say no, that we shouldn't adjust our investing behavior around that. Now, if you, let's say, come into a bunch of money, you have an inheritance, or you win the lottery, or something like that, and you're coming up on September, maybe you want to maybe avoid September, for a month or whatever, or maybe just put a little bit of money in each week or each month. It's called periodic investing, or in the United States it'd be dollar cost averaging, where you put in a little bit each time based on your currency. If you're India, it'd be rupee, cost averaging, where you put a little bit of your investment money in each month or each period, whatever that might be. As opposed to a whole big lump sum all at once. And that's maybe around September, but it's not as big a thing, particularly if you're a buy and hold investor. If you're not going to need this money for 20 years, whether you have a little dip in the upcoming September or whenever, it's not going to have that as big an impact on you. And as we can see, most months are better than there's only better than are always pretty good, right? I mean, there's only really 2 months where statistically they were showing, some negative numbers. So getting involved in the market's a very, very important thing. Now again, as I'm filming this, we had 7 straight months of positive numbers leading up to September. So maybe, that's a consideration, or maybe I put a little less in or something like that. Or I'm watching for a dip. Maybe there's a big drop early in September and there might be a buying opportunity there. So that might be some things I might be thinking about. But in general, trying to time the market is always a challenging thing and not really a good thing. If you're an active trader where you're constantly buying and selling, you're using technical analysis. I have like a 12-hour technical analysis course, or if you're interested in day trading or being a real active trader, that's different because you're actually really understanding what you're doing and you're doing a lot of buying and selling, and it takes a lot of thought around that and a lot of education learning. That's why I have the course with it. But if you're more somebody who's not doing that, trying to time the market is usually never a good thing to do. The other part of that too is you can't predict the future. I mean, we show some statistical stuff, but this September and the next September after that could be great, or it could be bad, right? It's all hard to predict the future, right? It's like the weather people, right? Or weather. If you're a weather person, TV, they get the predictions of the right some of the time, but certainly not all the time. Same with economists, right? Economists say, oh, the market's going to grow, or the market's going to go down, or this is good for this currency, or whatever, or bad. They're, for these people who have these advanced degrees or recognized experts in their field, they're wrong a lot of the time. So much amount of the time, it's kind of almost like voodoo, right? Like, are you just looking at tea leaves? What are you doing here? So it's a real challenge to try to predict these things. Plus, there's always anomalies on top of anomalies. So if the calendar effect is an anomaly in itself, you can have other things that are these big overarching things that can impact the markets that are an even bigger anomaly. A good example of that, of course, in more recent time is COVID-19, right? All the economists were saying that 2020 looked to be a pretty good year for investing. And what happened? COVID-19 starts to become this global pandemic. We start learning about it in February, market goes down, and then by mid-February, the market's really crashing. The market's really crashing. So could economists predict that? No, they couldn't. Could you say, well, February is a good month to invest in? Yeah, normally, not during a pandemic. So it went down. In fact, it was a good time to invest in after it gone down a certain period where you're buying low. That's when it was a good time to come back in. And as we saw in 2020, the overall market came roaring back, a really fast recovery, and actually had a good year overall for 2020 for both the broader market, and certainly some individual stocks had great years that were more part of that COVID economy. Other stocks less so. Think cruise lines in 2020, not so good. So now an economist, they would say, see, we predicted that. We said 2020 would be a good year. Well, you didn't tell us we were going to have this crazy downward part of that, because how could you know? It was an anomaly. There was this unexpected event that happened. So as far as trying to time this, it's very, very difficult. And the other big aspect of this is, I think really the most important reason, is behavioral finance, right? We're getting back to us being investors as human beings. And if you start putting things off because September not so good, or June's not so good either, because it's a little up but not much. Maybe I'll wait till January. That's a good time. That January effect, I'll invest in early in January. That's by the way, when you want to do it, if you're doing the January effect, you want to invest early in January. So I'll wait till early in January. And what happens is, if you keep putting it off, then you'll keep putting it off, and you may never invest, or you'll invest at the wrong, you may never invest is the thing. Or you're like, oh, okay, I'm going to invest in January, and all of a sudden that January there's all sorts of news, things that are scary, or the market might be down early in January, like, oh, I guess that's not going to work out this January. I'll have to wait till next January, or I'll wait till whenever, March or whatever, and then I'll sell in May. You start getting all messed up in the head, right? And the worst thing I think you can do, particularly if you're looking to invest for a long period of time, is being out of the market, being in cash, which is returning like 1%, or very low interest rates that are not even keeping up with inflation, the rising of prices. So if my cash is not getting much return, but inflation's rising, then my buying power is going down. I need to be ahead of inflation. What's the best way to do that? Statistically, this is the stock market. We'll see about cryptocurrency once we get more data and more long term on that. That seems, it could be an argument there for cryptocurrency. But we do know that stocks outperform bonds and well outperform cash over the long periods of time. Short term, anything can happen. There's volatility, but over long periods of time. So you want to be in the stock market if you were looking to invest in a long period of time to overcome inflation. At least that's what past performance and what the big idea is of investing, particularly over long periods of time. Particularly if you want to buy stuff and hold them and then keep adding to it as you get more money from your salary or bonuses, or you save money over time. That can have that snowball effect, and that can lead to where we all want you to be, which is financially independent. Retire early, retire whenever you want, have that independence by being financially independent. So there you have it. A lot of talk around calendar effects, particularly when you start coming to September. You watch for articles early in September, they'll all be talking about, oh, September's so bad, sell now, calendar, oh, the calendar effect says sell. And then January it'll be the opposite. It'll be like, you gotta buy now, early in January. Don't wait till the end of January, you gotta buy early in January because of the calendar effect. And so you'll see a lot of media outlets do that because, maybe it gets clicks, I don't know. Maybe I'm getting clicks because of it, who knows, right? So that's the idea behind it. Again, put in your comments below if you say, nah, I disagree with you, Steve, or I agree, or that makes sense, or your other thoughts on it. Would love to hear it. Put them in the comments. It'd be great. All right, so that wraps up what we're going to talk about here on the calendar effect. Just a reminder, go ahead and hit that subscribe button if you like hearing more about investing and stuff. I'm putting up videos all the time, so please subscribe. That would be great. If you like this video, give it a nice like too as well. With that, enjoy the time you have when you're out not investing based on calendars, when you're out actually investing and having your money work for you while you can enjoy life and do the things that you want to do. And the idea is that money's going to grow over time and give you more opportunities and more options for you later in life, as now you hopefully have a big pile of money later down in life. And you won't have to worry about, things like calendar effects. So with that, I wish you all the best of luck.